Hey, everybody, and welcome to Super Stonk Brothers we're on 7 now, right, Steve?
Holy crap, number 7.
We made it this far. Kind of surprising, but yeah, not too bad. And today we're actually going to try something new. We're going to actually talk about 4 specific articles related to investment, the economy, and so forth. And those four articles are: first, Charlie Munger's Daily Journal buys Alibaba by Yahoo Finance. Second, Jamie Dimon's bond warning isn't like Ray Dalio's by Bloomberg Opinion. Third, how the Biden capital gains tax proposal would hit the wealthy by CNBC. And finally, Apple's privacy ad Armageddon helps familiar tech giants by Bloomberg Opinion. How you doing, Steve?
I'm doing good, Macro. How are you, man?
Doing all right. Yeah. You have myself, Macro 108, Steve Palley.
Yeah. And we're ready to jump into it. We're doing a news medley. I'm so excited. Yeah. I feel like this show's really growing up. We'll do some deep dives. We'll do some medleys. We'll see what people like. And we'll go from there, right?
Yeah. One thing I wanted to clarify, I was just rewatching our last episode. And when I'm explaining something to the audience, I just want the audience to know Steve actually already knows everything I'm talking about. So when I'm explaining something, I'm not explaining it to Steve. I'm actually explaining it to the audience, just to be clear.
Well, that actually depends. When it comes to App Lovin', yeah, I mean, we've both dealt with it extensively just in our day jobs. So yeah, I have a little bit more knowledge, but when it comes to other stuff, you're definitely in the driver's seat. So yeah.
Well, hopefully we learn from each other.
Exactly.
Definitely a lot we can learn.
Yep.
But okay, maybe just jumping into the news. And this first article is by Yahoo Finance, who's reporting that the Daily Journal Corporation, which is actually owned by Charlie Munger, famous for Berkshire Hathaway, has made a significant investment into Alibaba at the end of last month, so the end of March. And the holding company now owns its portfolio weight in Alibaba is now 19% of the portfolio, which is worth about $37.5 million. And it also now represents the company's 3rd largest position behind Bank of America and Wells Fargo. Yahoo also notes that the last significant change to the stock portfolio occurred back in 2014 when it reduced its position in South Korean steel producer POSCO. Another important note from Yahoo is that Munger is very close friends with Li Lu, who manages the $30 billion Chinese value fund, Himalaya Capital.
Interesting. So Charlie Munger obviously is Warren Buffett's right-hand dude at Berkshire Hathaway. He has this holding company of his own under his own control called the Daily Journal Corporation, which is a weird name for a holding company, but whatever, right?
Well, I think it's because it was like a newspaper,
right?
Like a newspaper company, technology company, and I guess kind of a investment holding company of sorts.
It is now, yeah. and the first 2 holdings are big banks, which is very, very sort of Berkshire Hathaway-like, right? These guys are the ultimate value investors. So what Munger does, and some would argue he does it even better than Warren Buffett, is he finds undervalued companies, buys them at a discount, and then holds them forever. Right, Joe?
Yeah. As you know, I'm a huge proponent of holding forever. It's one of the biggest lessons I've learned from just making so many mistakes, trying to think that I'm smarter than the market. I think the key, a huge key to being successful is really like having a fundamental understanding of what key theses are, like how will the future unfold, but not being a stickler for timing, like holding against a thesis and letting the market play out. Like
taking emotions out of it, right? Basically.
Yeah. Again, we're just like, as human beings, we just are not smart enough to be able to predict timing. I think it's much easier to predict trends, but timing is something that's hard to predict. And so for the purpose of not being able to predict timing, as well as for tax implications, holding forever. Holding forever is the right strategy.
Yeah, I found that out paying taxes this past week or two on 2020. 2020 was, shall we call it, a crap show from a capital gains standpoint. So holding forever, or at least a year, is a really good idea. And maybe we'll have a mistakes episode for our greatest investing mistakes at some point in the future, because I'd love to talk about how that went.
You took a short-term capital gains hit on that?
A little bit.
Yeah.
A little bit. And then you get caught in this vicious cycle where you need to sell more stuff in order to cover your tax hit, right? And it just goes from there. It can get pretty nasty. Anyway, please continue.
Okay. Well, as someone who's worked in China before and for a Chinese company, you got to think that, I mean, it's not the same. China is a little bit of a different type of country with different norms around information sharing in particular.
Mm-hmm.
And so in China, the typical guards against inside information is not the same. And so you got to think, if Munger is friends with Li Lu, there's probably some information. Look, I'm not saying Munger has inside information, but I'm just saying it's not like the US. And even in the US, like, people really underestimate the impact of inside information. It happens all the time. I've received inside information that I could have traded on multiple times. And, it's just a part of what happens, but in particular, China. And so I think that when you think about dollar devaluation, one of the key things that you really have to think about is, how do you protect yourself against dollar devaluation? China should be one of the best strategies that should be considered. Now, whether it's, we've talked about Bitcoin before, we've talked about gold before, but I think you really have to have more international exposure. If you're thinking international, the only other country of significance is China. So I think that in order to have China exposure, I initially invested in Alibaba because of Ray Dalio, and I saw what Ray Dalio is doing. And so if you've got both Ray Dalio and Munger making big bets on Alibaba, and it's a great time to buy Alibaba, in my opinion, just because of all the government crackdowns on Jack Ma and all that kind of stuff have depressed the stock. The delay of the Ant Financial IPO and the potential impact to the valuation. So I do think that if you're not in China, maybe you might want to consider something like Alibaba. If I had more capital to deploy, I would be looking at, biotech stocks. I would be looking at Alibaba.
Additional Baba, right?
Yeah.
Yeah, that makes perfect sense to me. And we know that Munger looks for undervalued companies whose valuation has been depressed, maybe for short-term reasons. And we know that the Chinese government has gone after Jack Ma personally recently for comments he made, I guess 6 months ago now, about how Ant Financial was going to revolutionize sort of the state-run banks and the Chinese financial sector. And the Chinese Communist Party really, really did not like hearing that. And so it looks as though they admonished Jack Ma, and there is a chance that they're going to remove him from control of Ant Financial, which is obviously bad for Ant. And it delayed Ant's IPO and all of that on the New York Stock Exchange. We'll see whether or not that goes forward. The point is that some of that contagion, some of that bad feeling, that bad mojo ended up all over Alibaba, which is a separate business, right? And so it's probably not fair. Baba is still a good business. Jack Ma is in trouble with the Chinese government, but is the Chinese government going to come in and shut down Alibaba? Almost certainly not, right? They need it. It's a tentpole. It's kind of a national champion. In fact, it's the Chinese Amazon. It's the way a lot of people describe it. So even if bad things happen to Ant Financial or Jack Ma, I think Munger is making the point, hey, this is still a good business. And whatever happened to the stock price over the past 6 months is not really indicative of what it's actually worth from an underlying perspective.
They are tied to the extent that Alibaba owns a big chunk of Ant Financial. So, but I totally agree. And I think that, this may be a rare opportunity to get into Alibaba at these prices, assuming, depending on how things play out. So definitely worth looking at.
Yeah, to your point, as a dollar hedge, the next article we're going to talk about is about inflation and dollar devaluation. Yeah, it makes sense. I agree that China is a great place to go. I own a couple Chinese ETFs, or you can go concentrated, like Macro has. Just depends on your preference and your risk profile. There is another currency of significance, and that's the euro, which I think is less risky in some ways and more risky in others. But all three major currencies, whether that's renminbi or a euro or a US dollar, now have major risk profiles attached to them.
Let's say Alibaba goes down 15% and then the dollar devalues by 90%.
Right. Right. It's kind of a wash, right? Yeah.
But
or
anyway.
magnifier, actually. Yeah. I'm with you.
All right. Moving on to the next article. Steve, you want to take this one?
Absolutely. So this article is about Jamie Dimon's sort of annual shareholder letter to the shareholders of JP Morgan, which is the largest US bank. Jamie Dimon is this guy who looks like a politician or a movie star. He's the biggest banker in the United States and by some measures, therefore, the world. And he's kind of like the chairman of the entire finance industry in the United States. And he warned about American debt, American Treasury bonds in his shareholder letter to JP Morgan. So that's a big deal. And another billionaire tycoon, Ray Dalio, has also been talking about the performance of American debt and what he thinks about American debt. So when two billionaires of this magnitude basically come together and start talking about how they don't think American debt is priced properly, that's potentially a very big deal for the entire world. So I thought I would dive into it, right? And specifically in this letter, Dimon wrote that, quote unquote, it's hard to justify the price of US debt, seemingly agreeing with this other guy, Ray Dalio, who we talk about a lot, right? Very famous investor, Bridgewater Capital, who has said the economics of investing in bonds has become stupid. And I prepared a little visual aid here. Yeah, scroll up here. Here's what he had to say. I have little doubt that with excess savings, new stimulus savings, huge deficit spending, more quantitative easing, a new potential infrastructure bill, a successful vaccine, and euphoria around the end of the pandemic, the US economy will likely boom, right? Just because of all of this cash and all of this pent-up demand pouring into the marketplace. This boom could easily run into 2023 because all the spending could extend well into 2023. In this boom scenario, it's hard to justify the price of US debt. Most people consider the 10-year bond as the key reference point for US debt. This is because of two factors. First, the huge supply of debt that needs to be absorbed. And second, the not unreasonable possibility that an increase in inflation will not be just temporary. And he goes on to say, all of these buyers, meaning potential buyers of Treasury debt of the United States, sovereign debt, will seek out alternatives. And there are always some if they become worried about the long-term sustainable value of Treasury bonds. And remember, annual inflation is already running at 1.7%. So that's a clear warning. And I thought that it would make sense to unpack it because this is potentially a very big deal for the future of the country and the markets. So here's a little primer on sovereign debt math 101, which is this bond math is way more complicated than it is made out to be here. I'm just talking about a few different aspects of what Dimon is talking about. And so when it comes to the relationships of how much debt is in the market and kind of what happens to the price and other factors, this is kind of how those causal relationships work. First of all, here, can you zoom in a little bit? Yes. When the debt supply goes up, the price of existing debt goes down and the yield goes up just because of supply and demand, right? Other things equal, if demand stays the same and you increase supply, the price goes down, right? And if the price goes down, the yield, the percentage yield that a debt instrument returns is just the interest payment over the principal price paid, right? If the price lowers, that's the denominator on that ratio lowering, which means that the yield naturally goes up. And if the yield goes up, that means that other things equal, the US is on the hook for more money on a unit basis to get that debt sold in the future, right? The US does not want to see yields go up, right, Joe? That's very bad because it means that they have to pay back more and more. Furthermore, when the debt supply goes up, the yield goes up for another reason, right? Which is just that the default risk goes up of the United States. Now, the default risk of the United States is not very high at all. If you go to what's called the sovereign debt credit default swap market, And that's a mouthful. This is just a fancy sort of financial instrument whereby traders bet on the possibility of a sovereign default for all these different countries, right? The United States is one of them. And right now, it's basically sub 1% over the next 10 years, which is a low risk, but it's not zero, notably. And as we spend more and more money, as that debt supply goes up, just like any other creditor, the public, people who might consider buying this debt for a return, start to look askance, right? Because, the more debt that you take out, the more of a credit risk you become. It's just like, going to the bank and asking for a loan. It's like, well, how much debt do you have outstanding? When are we going to get paid back? Are we going to be first or last if you default, right? Your risk goes up, which means the yields have to go up as well. And then finally, if spending goes up, so, this is what Dimon's talking about with the stimulus bill, with quantitative easing and so on. We're just going to spend, 1.9 trillion on the American Rescue Plan, and the infrastructure bill is another 2.2 trillion. Do I have that right, Joe? It's into the trillions, right?
Yeah. I don't know the exact numbers.
A lot of spending, a lot of obligations. That leads to a rising yield as well, because inflation goes up. And when inflation goes up, recall that the real return of a debt instrument is basically that yield minus inflation, right? So debt investors, if I'm going to buy your debt, I want that yield to go up just to compensate me in that race against inflation. If money is pouring into the economy, inflation is going to go up, right? So you see these relationships. This is what Dimon is talking about. All three of those yield arrows are pointed up, okay? And the United States really doesn't want that to happen. And so the risk is that the yield goes up while the debt supply increases, and the debt becomes unpayable, resulting in a sovereign debt default and/or hyperinflation and/or loss of reserve currency status. And this is what Ray Dalio thinks we're headed for, right? Basically catastrophe for the United States and a changing of the reserve currency guard. It's kind of the Argentina scenario. This happens repeatedly to developing countries. They get unsustainable debt. They default on their obligations. The yields go too high. They can't pay back. And then they have to do a hard reset with austerity, sometimes a new currency, and it starts all over again, right? Argentina, like this has happened repeatedly to Argentina. And Dalio sees this in the United States' future. And I think you do too, right, Joe?
Yeah, I mean, I see inflation is a huge risk. I'm a big proponent of Dalio. I would say that the one thing in terms of like the yield question though is like really about demand, right? And so to me, the big question is, so right now, the U.S. government is stepping in and filling any unmet demand.
Debt monetization, right?
Yeah. So the question really to me is this an unlimited capability to like issue Treasury and then the government comes in and buys any unmet demand?
Yeah.
Can that continue forever? Is that unlimited? That's something I don't know.
Well, so the answer is yes, in the case of the United States, because it enjoys reserve currency status. However, what that entails, what debt monetization entails, is printing money and injecting it into the economy, right? Because you're just constantly printing money and handing it over to the Fed, right? It's like the Treasury is just printing money and buying debt, and then that goes into the larger economy through the banking system. And unless you do sort of fiscal dominance or financial repression, so yield curve control and stuff like that, this is going to result in inflation, like pretty much no matter what.
So then if we assume that scenario, that means there will be massive inflation, which is my underlying assumption that this is a scenario I believe is going to happen.
Right.
Now, if they don't buy that debt, and this is what's kind of being priced into what has been being priced into the market, and the other school of thought is that interest rates are going to increase because people think that the government isn't going to buy the excess debt or something. And so then that's why there was this kind of sector rotation into value stocks away from growth, because people thought interest rates were going to go up.
Right.
And that part I don't understand well enough. Like,
Neither do I.
I don't understand that school of thought.
Yeah,
So,
bond math is really, really complicated. Like I've drawn some basic arrows and flowcharts here, but like the real sort of flowchart when you talk about sovereign debt's relationship to like the broader economy and global trade and all of this stuff, it's like a spaghetti chart where everything connects to everything else and everything causes everything else. So it's way more complicated than I've laid out here. I'm just talking about what Dimon is talking about and what Dalio has been talking about in this article. Right. Now, Dimon has a different idea, though. Later in his shareholder letter, he says, being the optimists that we are, we believe that there's a Goldilocks scenario. It's still possible for the United States to avoid sort of this Dalio Argentina scenario, it's sovereign debt default. And the way you do that is you use that spending, you leverage that spending, you spend on the right stuff, and you have just enough inflation to reduce the debt such that economic growth as a result of productive investment, plus tax receipts exceeding growth and debt, right? So you raise taxes a little bit, you grow the economy. So basically you get more tax receipts. You can outrun the debt that way. Plus rising yields can result in the Goldilocks scenario, right?
Yeah, I think the problem right now with the Goldilocks scenario is that we're not seeing, so that assumption of investing into production, productive assets, that's the big thing where I am a little bit skeptical. Now there is a move, and we talked about this before during our inflation talk, that there is repatriation of production back to the US, and that's going to happen slowly. I just think that can all of that happen fast enough, as well as investing into things that will increase production for the US so that we don't have as big of a deficit as we currently do. But when you look at from a deficit perspective, we're heading in the wrong direction right now. I mean, as a country.
Yeah.
So
I think it's really difficult to argue otherwise. I agree with you. The question is, do you believe that the administration is spending money on the right stuff? Are they spending the money on productive investments that will result in longer term growth such that we can outrun this like debt service scenario that results in default, right?
I think Biden, and now I think we can't avoid talking about stock investment, the economy, without talking about politics. I actually do think Biden at the high level is doing the right things from in terms of some of the spending in terms of green tech, clean energy, things of that nature. That's the right move.
Yeah.
But how fast we'll be able to see the fruits of that. The other thing he's doing is he's trying to invest in education, right? Which is
right.
We absolutely need to do that.
It's like a free community college for everybody, right? That seems like a good idea. So as an investor, though, for a long time, like a really basic and really effective investment strategy was to invest in 60-40 portfolio, right? 60% equities, so stocks like Alibaba or whatever else, Tesla, 40% debt, right? So this could be corporate debt, it could be treasuries, it could be foreign debt. All of them are related to that underlying treasury interest rate, though. And stocks and bonds are correlated in negative direction, right? So when stocks go up, bonds go down and vice versa. So that was a really nice sort of all-weather portfolio. And in fact, Ray Dalio made his name initially by developing this portfolio style, as I understand it, right? He was one of the first proponents.
Yeah, he has something called an all-weather portfolio type.
Yeah, and it relies on bond investment. And now he's saying investing in bonds is stupid, quote unquote. And Dimon's kind of saying the same thing. It's like, it's hard to justify this price, like given where we think yields are going to go, right?
Yeah, and I think I actually was just watching a YouTube interview of Charlie Munger yesterday, where he was saying that over the next 10 years that equities returns in general are going to underperform on a real basis, right? In real terms. So, and I think when you see some of the longer term trends, like we've had this massive bull market for the past, 30, 40, however many years.
Yeah.
And part of the big change that has occurred is everyone then is just doing, passive index investment, which but that has a problem too, right? Because now everything's everything's getting invested into. So there's no, like, I think
there's no alpha.
And I think Michael Burry calls it like price discovery, right? Like everything.
Yeah, also true. Yeah.
And so I do think that, and not to go too off topic on this, but because of some of the big macro things that are happening, that the overall returns on equities without a differentiated, what I would argue for a concentrated, differentiated strategy is going to be hard to make alpha, additional return.
And as far as holding debt, like I've liquidated all of my debt positions. I had some fairly substantial debt positions, coming into this year, but just reading stuff like this, it's like the price of that debt's going to go down a lot, right? The only way it could go up is if interest rates were to fall, and interest rates are already as low as they can go, right? So it's just not a good move to hold debt. But now I'm sitting on this cash. It's like, well, what do I do? Do I invest in equities? Do I invest in Bitcoin?
Right now would be great to like buy a house, whatever, and
real
get
assets,
as much. And having debt on your house is good.
Yes,
like,
it absolutely. Yeah. Eventually, like lenders are catching on to this, right? They see inflation rising, so they're going to require higher rates for that reason. But it seems to lag inflation because measurements of inflation are artificially depressed, right? Yeah. And these lenders have to go off of whatever the government says in most cases. So yeah, now is a good time to buy real assets, but I'm lazy and I don't want to do that. So maybe I buy ETFs or stocks that invest in condos or housing or farmland or stuff like that, right? Real assets.
Right. And just going back to the article, I would say that I would highly recommend actually going through and reading Jamie Dimon's shareholder letter. I mean, there's some like typical kind of fluff and marketing there, but some good parts. Excellent section on leadership. I would highly recommend people in the audience read that part. And then he raises some issues that we should be aware of. For example, he talks about the rise of shadow banking and fintech relative to the size of US and European banks. And that unlike the banks, the shadow stuff and the fintech stuff, there's a lack of regulation on those sides. So this is kind of out of scope of our current discussion, but probably worth talking about in the future. And then that section about COVID-19 and the economy, which was the focus of the article, I think it is worth going through all of the points and notes that he makes. A couple of things that did stand out to me was that there was mention that in 2020, so last year, the Federal Reserve did buy essentially 100% of all new issuance of Treasury notes and bonds, meaning that that demand, right? Like the demand wasn't there. So
that's monetization right there. Yeah, exactly.
And then in 2021, Jamie Dimon notes that the Fed's current QE commitments, well, here he says the market will have to absorb 2.2 trillion in government debt, approximately 85% of which will be in longer duration maturities.
Right.
So, yeah, and then we talked about the point being that we'll see what happens, but understanding where this is going to go will have a huge impact in terms of whether we see more inflation or if interest rates are able to go up. Do go up because of lack of demand. And if the government can't absorb the additional debt, then we should see a stock market crash. So.
Great. Then you're going to want to own all the houses.
Yeah. And I would say and then in terms of the inflation scenario, a few things to think about is what can the government actually do to stop inflation? Well, I mean, so once we could try and stop spending so much, but is that realistic in the current time with all the stuff happening in our economy?
No, I don't think political parties are now all about spending to the maximum. So
so I don't think that's a realistic possibility. Second would be to find a way to spend more efficiently. The government, both the federal government and state governments, are notorious for wasting massive amounts of money. But I think that the ability to have enough transparency and to be able to affect controls on government spending is just too tough. But that would be a possibility. There was a video that went viral where Katie Porter was ripping a big oil lobbyist. And she pointed out that big oil received $30 billion in federal subsidies in 2020, which then got turned back around in $139 million in political donations to Republicans and $111 million in lobbying. And so you can see, like, because of this sort of, this sort of scenario, we're going to just continue to see a lot of wasted money that goes out in various forms.
Right.
I think the third area would be helping fund new industries that will generate more production, to the point that we talked about earlier.
Right. And this is what Dimon's talking about, right? Like, if you choose correctly, right? If you subsidize the right things and you have the right policies, then you can actually outgrow this scenario. But it's like Indiana Jones with the frickin' rock trap, right?
Yeah.
You got to stay ahead of it.
I think the other thing to do, and we talked about this before, is like, fundamentally, one of the biggest problems we have in this country is that our education system is broken, right? Mm-hmm. And I know, so I mentioned before, I'm not a huge fan of Biden, but I do think this is an area where he's trying to do the right thing, right? Mm-hmm. So he's trying to fund education and divert more money there. And I think the final thing is, increase taxes. And so we'll talk about this next, but Biden's latest tax proposal plan is to increase taxes for the top 1% or 0.3%. And those are the different things that could potentially happen. But given all of that, I got to think that, there is just not enough that's possible or that can be done to stop inflation. I think it gets away from us.
A definite possibility. Yeah, I would agree with that. And Dimon agrees with that. He's like, there's a Goldilocks scenario that we're hoping for, and we believe is still possible. But there are other scenarios too that are not so great, Yeah. So anyway, what are we talking about next?
Okay, next. So related to what we're just talking about, but CNBC is reporting that President Biden is expected to propose doubling long-term capital gains tax. And under the proposal, the rate could be as high as 43.4%. And just for clarification for our audience, so long-term capital gains means when you sell a stock, if you sold your stock after holding it for less than a year.
Short term, do it.
Short-term capital gains, you get taxed as ordinary income. So whatever your normal federal income tax bracket is, that's the tax on your gains.
Don't be me. Don't get a nasty surprise from your accountant.
But if you hold it for longer than a year, then it'll be either 15 or 20%. Mm-hmm. So the proposal by Biden is that the long-term capital gains rate would be jacked up from 15 or 20 to a top proposed rate of 39.6%, but for those with income of more than $1 million. And my take on this is that there are like so many Silicon Valley douchebags that are just getting so hella bent out of shape over this.
And can we print T-shirts with Silicon Valley douchebag on it? I feel like that would sell really well. So this catchphrase.
So a couple of things here. First, if you follow the macro 108 investment strategy, which is to hold forever, mm-hmm. long-term capital gains literally don't matter, right? Like, just don't sell. And if you need liquidity, just get a portfolio line of credit. And so, for example, M1 Finance is a program called M1 Borrow, where you basically get a line of credit for up to 35% of your portfolio value at rates as low as 2%. So you're paying 2-3% against 35% of your portfolio. So if you buy and hold forever, the tax won't affect you. And again, not to get too political, but I feel like this issue is making a lot of people rather irrational. And so it kind of shows to me just how good the Republican Party is at marketing. Like, they have somehow convinced people, not even Silicon Valley douchebags, but people who don't even have a net worth of $1 million.
Yeah, right? Not even close, right?
That for an issue that requires making more than $1 million in a single year, that this issue is destroying our country. And it's in the woke left, ultra liberal, socialist, Democratic Party is destroying our country. Yeah,
Bernie Sanders.
It's like, and look, I'm not a fan of either party, but this is just ridiculous, right?
Yeah. like all this does is raise taxes on investment income for people who are really rich to the same level that wages are taxed at.
Yeah,
basically.
And this is a policy that literally affects 3 people out of 1,000.
Yes.
But the dogma and confusion around this is just really, really crazy. And like, we've got people who are like, oh yeah, this is going to cause so much inflation because nobody's going to be incentivized to save anymore. Like they're just going to spend all their money because they have no incentive to save. But it's like,
no,
really?
They have more incentive to hold, right?
Like,
it doesn't make any sense.
So who is this going to impact? And so like for me, while my heart goes out to like the 100 millionaire who's selling his stock to buy his private jet, or the billionaire who's selling his stock to
maybe a second
own
island.
their own sports team or island. Yeah, look, you know, my heart goes out to those guys, but honestly, this is stupid. Like, and these people who are talking about how this is turning us into a socialist country are just, it's so ridiculous.
Well, they're paid liars, right? And they're trying to fire up their base. But what this does to me is just restore balance, right? We need public goods in this country. We need to pay for education. And this is a lot more responsible than simply printing money, right? This will claw back $350 billion or something, which is not that much over the course of 10 years, but like, you know, cushions some of the blow, and it restores some confidence in the United States from external investors who are like, oh, you're not just printing money, you're actually raising taxes on rich people too, right? That's what they want to see, if you ask me.
Yeah. So anyway, I do think that, to my point, really, like, Republican Party so good at marketing.
Yeah,
right?
You're right.
Like, you know, I mean, these terms now in terms of the woke left, the socialist party, cancel culture. And so like giving these labels applied to things to prevent a discussion from happening, right? It's just, oh, we're going to label it. We're going to label these things.
Yeah. They're very good at appealing to emotions, right?
Right.
And coming up with these like, and Trump was really good at this too. He was really good at labeling stuff in a very simple, emotional way, coming up with catchphrases, right?
Now, let me be fair. Like, I hate the Democratic Party for being so wasteful and corrupt at the city and state level.
Yeah.
And I'll call them out for that. But this is just ridiculous. Like, all the anger and vitriol and hate about this is just crazy.
Yeah. I think hopefully what happened was Biden's team did an analysis of all the people that are going to get hit by this. And they realized that many of them are already GOPers, right? So they had already lost them anyway. And the other people that are currently Democrats that are going to get hit by this are very unlikely to go to the GOP at this point, because the parties are so far apart on practically every issue. There's so much polarization, right? So they're probably anticipating not a lot of net impact in terms of donations or in terms of votes from this. And what this does do is it does fire up the populist left for sure. Like, AOC is going to love this. Bernie is going to love this. Even if it's not being done for them as such, it's being done for the good of the country, right? Like, they can take this and run with it to their base, which is like sizable and really highly motivated, and will turn out in 2022, right? I think that's the bet.
Well, I will say that I do think that Biden trying to address debt is a good thing. Like, debt is just getting way out of control.
Yeah.
And at some point, even with 0% rate of interest, like, it's a matter of the size of servicing the debt level of the country, right? At some point, it's going to just destroy this country if the servicing level gets too high. Mm-hmm. Then we're going to have to inflate like crazy to like reduce the real cost of that, and then we wind up with a Ray Dalio scenario. So
this is not going to affect investors like you or I don't think.
Yeah, and either way, if you invest forever, you're not going to get invested. You're not going to get affected anyway.
Yeah. So. Or next to forever, right? Depending. Cool. And then we have one last article to discuss, right, Joe?
Yep.
And this is Apple's privacy ad Armageddon helps familiar tech giants by Take Him. And this is another Bloomberg opinion piece. And we made reference to the privacy moves on Apple's part last week as part of our App 11 breakdown. And so we wanted to close with something that's a little bit less big picture and more small picture, I guess, which is, again, this kind of bears on our particular experience in the mobile games business and a lot of companies that we're familiar with, right? So we can talk about it a little bit more in depth. So iOS 14.5 is coming out on Monday, the 25th, I believe. And with it, it will come a new privacy framework whereby every app will now have to ask user permission in order to track user data across apps to ad networks. And this is a really big deal because if a player or a user of an app opts out, it breaks the data link between AdWorks and advertisers, resulting in worse targeting and lower overall effectiveness. And we talked about this last week in relation to App 11. And a lot of estimates out there are assuming very high levels of opt-out, which I think is correct. Online dating app Bumble Incorporated cautioned in its prospectus that more than 80% of users may decide to opt out, while Snap Incorporated acknowledged this past Thursday that Apple's changes were an important milestone and could significantly affect how they work with advertisers. Now, all of that said, though, the kind of thrust of this article is that you'd think that this move is aimed squarely at Facebook and Google, right? By Apple, because those are competitors and they're the biggest advertisers that sort of interact with the App Store ecosystem. And so breaking the flow of data to and from Facebook and Google and these third-party apps should be extremely painful. But a Bank of America analysis has indicated that it'll only hurt Facebook's revenue by something like 3%. It's going to be a lot less significant than people think. And furthermore, Facebook and Google both own gigantic and expanding walled gardens. And Apple's changes don't affect data moving around on a first-party basis. For instance, between the Facebook app, WhatsApp, and Instagram, all of which are published by Facebook, right? And of course, Google has all of its work apps, for instance, right? It's still totally fine to shuttle data in between those apps. And meanwhile, demand for advertising isn't just going to disappear, right? Especially for e-commerce and stuff like that. So advertisers are still going to want to advertise in these apps for their products. And if you're able to buy stuff directly on Instagram, for instance, this will actually help Facebook in the long run because it destroys the competition. And what this really does, and again, we talked about this in reference to App 11, which is growing a gigantic walled garden as quickly as possible. Facebook, Google, and the other big players will be incentivized to internalize everything as quickly as possible, and they have the resources to do so, right? They're the biggest companies in the world, and they're just going to get bigger. And so the question I'm asking is, does this mean, in fact, the rich just get richer? And if that's the case, how does this affect your interest or lack thereof in big stocks like Apple, Facebook, and Alphabet or Google? What do you think, Joe?
I mean, I do think that Apple clearly becomes a winner. Like you have, when you think of the margin in the app ecosystem that Facebook and Google were taking, it was a huge bite.
Right? Yeah, and we all have to pay it. It's a tax, right?
Yeah, and so based upon the machine learning based approaches to ad targeting, like AEO, VIA, for people in our audience, that specific form of targeting ate up so much margin. You basically had a lot of app developers or game companies that were spending to the max and were barely or even slightly negative in terms of profitability.
Right.
Whereas Facebook and Google were just eating up all that margin, right?
Yep.
So now where does that margin flow? Now that margin probably, I'm hoping, flows back to developers, flows back to consumers. And you got to think it's going to, Apple's going to be taking a big piece of it too.
Yeah, here's the thing. Apple has its own ad network, and it's not applying its own rules to its own network from what we can tell.
Yeah.
So this is extremely dirty pool. And it also gives them a really nice story around privacy, right? Because they're treating Facebook and Google like big tobacco. And they're saying, come buy Apple devices. Like you won't be subject to being followed around the internet and bothered by these targeted ads, right?
Yeah.
Like, come enjoy your privacy on our platform. And it's like, well, sort of, except that you're actually expanding advertising on your platform and you're just taking the money yourself, you know? So it's pretty hypocritical, but also I think a great business move. What do you think about Facebook and Google though?
I do think that the B of A analysis, I mean, I don't know where they got that 3%. I don't know how they did.
I didn't read the article. Yeah.
Probably better to dive deeper into how they actually did that analysis. But I did see other analysis that showed kind of the amount of money that Facebook and Google were making after the adoption or after the rollout of AEO and VO, which seemed massive. Like I was looking at some of those charts and I was like, holy shit, that's a lot of money. And a lot of additional revenue. So I would be surprised if it's only 3%. I mean, maybe Facebook, I don't know, maybe the size of their, but you got to think a lot of their revenue came from mobile ads, right? So I don't know. I would be surprised if it's 3%, but again, I haven't looked into the details of that. So, I mean, on the face of it, you got to think it's positive for Apple, negative for Facebook and Google. And yeah, I mean, exactly how much, it's hard to say. You know, the other potential loser here would be companies like Unity. Unity derives over half of its revenue from ads. So do ad CPMs decrease? Maybe, maybe not.
They need their own walled garden, right? They need to do the AppLovin thing and become a publisher. And like, you know, you already are developing using our technology. Now join our platform, right? And that's probably where they will go next.
You know, that might be actually, speaking with respect to Unity, if they became a place where they actually had, like, you know, stored, you know, data, like whether they became a publisher or whether they were able to store enough user data under a single account so that we could use IDFB somehow, then yeah, I definitely think this could be a net positive so it could be negative for Unity, but if they figured out a loophole, then it might actually be positive for them.
I think they can. Yeah. I mean, like they have analytics in Unity. They're not very good, right? But like they can push some chips there. And then develop their own, you know, in ecosystem ad network.
If there was, for any developer using Unity, if you could just, you know, click a button and it says, okay, I opt into this or whatever, and
just handle all of my marketing, just handle all of my marketing, all of my UA, all of my analytics, just take all of that off my plate. That actually makes a lot of sense. I think that would be a pretty compelling value proposition for a lot of developers who just don't want to do any live ops and don't understand it because it's really hard. As for Facebook and Google, I don't own either stock. I am ethically against both of them.
Really?
I am.
Google?
Google too. Google's not as bad as Facebook, but I think they're even more powerful, which bothers me. I divested from both basically last year. And I don't use any Facebook platforms, and I try not to use Google. Like I'm on the Brave browser instead of Chrome. And obviously, I still use Gmail. I have to for work. But I reached the conclusion that social networks were bad for me personally, bad for the country, and bad for the world. So I try to talk my book, right?
Yeah, I mean, I don't use Facebook, but I do believe that AlphaFold is a big deal. So I do own a fair amount of Alphabet. And I don't know. I do think that's one of my, you know, that's one of my core holdings actually.
Yeah. The other thing to note is that Google owns its own competing platform. It owns Android, right? So they can do whatever they want over there. They'll do something with privacy, but they're likely to gain in the short term, just on an adjusted basis against Apple. They may take some market share from developers because you can do UA still on Google.
Yeah, that's true. So actually probably positive for Google.
Yeah, short-term hit, longer-term gain, I think. And same goes with Facebook, because Facebook has that incredibly powerful ecosystem. They're really good at stealing other people's ideas and turning them into their own apps quickly. They're trying to do it with Clubhouse right now. And that strategy will just get more and more aggressive, I assume, as a result of this. Yeah.
All right.
We're at 1 hour. Hey, not bad.
All right. Well, there you have it. Our new format here. If you guys like it, let us know in the comments. Otherwise, we'll see y'all later. Bye.
Thank you. Bye.